Look at housing prices, they're skyrocketing.
But wages are flat. How can anyone afford this?
Studio for 1.22 million, it's insane.
And rents are up again.
What if owning a $10 million skyscraper cost less than your dinner? Not a simulation. Not a game. Not a crypto meme. An actual financial asset. Legal ownership. Under $50. For a century, the most valuable assets were locked behind one wall. Not intelligence, just capital. Real estate, private equity, commercial property, world-class art. Not illegal to own, just practically impossible to access. Until now. Something is being built, quietly, without headlines. It's called tokenization, depending on who you ask. The greatest democratization of wealth in modern history, or the next financial illusion dressed up in blockchain? Today we find out which one it is. Let's start at the beginning. The problem. The modern economy created a strange paradox.
Hey, buddy, what's up? Okay, come here. Good boy. Let's find us a home.
People are more connected to markets than any point in history. In 1980, a home cost 3 to 4 times annual salary. By 2025, that ratio hit 8 to 10 in most major cities.
I spent 2 years trying to get into real estate. Not flip a house stuff, just own something. Every platform I looked at wanted a minimum I couldn't touch, even the crowdfunding ones. 25,000 minimum. I started to feel like the whole system was designed for people who already had money.
Jake is not an outlier. He is the median. Younger investors face 3 compounding constraints. 1. Limited starting capital. 2. Asset prices outpacing wages. 3. Restricted institutional access. Bottom 50% of Americans own less than 2% of all equities. Commercial real estate, 90% held by institutions. This is not an accident. It is a structural feature of how capital was organized before the internet. But for the first time in modern financial history, that structure has a crack in it. And that crack has a name. Tokenization. Let's understand exactly what that means.
Every platform I found either needed me to be accredited or locked my money for 7 years minimum. I earn a decent salary. I just don't have $50,000 sitting around waiting to be locked up.
Constraint 2. Asset prices that have outpaced income growth every decade since 1980. Constraint 3. Accreditation barriers. 87% of Americans do not qualify as accredited investors under current SEC rules. Traditional finance was designed to manage wealth that already existed, not to create entry points for wealth that hadn't formed yet. The statistics are not subtle. Fine art as an investment, accessible to roughly 0.1% of the global population. Tokenization sounds like a technology problem. It is actually an ownership problem that technology is solving. Core idea in one sentence. Take a real-world asset, divide legal ownership into digital units. Anyone can own it. Think of it like a pizza. One whole pizza costs $10 million, sliced into 100,000 pieces at $100 each. You buy 3 slices. You own 0.003% of the pizza. Now apply that logic to a Manhattan skyscraper, a Picasso, a Texas wind farm. These tokens are recorded on a blockchain, a distributed digital ledger. Nobody controls and everyone can verify.
Think of it like a public spreadsheet, except nobody can edit it without everyone seeing it, and nobody can delete it.
Every transaction is timestamped, permanent, and verifiable by anyone on Earth. Ownership becomes transparent, transferable, and programmable.
The internet digitized information. Tokenization digitizes ownership.
More access doesn't automatically mean better outcomes. The internet also gave us fraud at scale.
The infrastructure is verifiable by design. That's structurally different from prior financial innovation.
Both things are true simultaneously. The infrastructure is real. The risks of specific products built on it are also real. And right now, the world's largest financial institutions have made their position clear. They're building on it. Take a real-world asset worth millions. Divide legal ownership into smaller digital units. Each unit, called a token, represents a fractional ownership stake. You can buy, hold, trade, or sell that token. The token is just a digital certificate. The blockchain is the tamper-proof registry that records who owns what.
It makes participation accessible to anyone with capital, regardless of how much they have.
Verifiable infrastructure has never stopped bad actors from building bad products on top of it.
You're not wrong, which is exactly why we're going to cover every risk in full before anyone invests $1.
I'm holding you to that.
The infrastructure is real. And right now, the world's largest financial institutions are proving it with capital, not words. This is no longer a conversation about crypto speculation. This is infrastructure planning. BlackRock launched the BUIDL Tokenized Money Market Fund on Ethereum in March 2024. BUIDL crossed $1 billion in 60 days. It crossed $2 billion by 2025. The fastest growing tokenized fund in history. JP Morgan Connexus, formerly Onyx, rebranded 2024, has processed over $1 trillion in tokenized repo transactions. Franklin Templeton's Benji Fund put a money market fund on public blockchain in 2021. Still running, fully regulated. Here is the efficiency argument in one fact. U.S. equities settled in 2 business days until May 2024. The SEC retired T+2 and moved U.S. markets to T+1 in May 2024. Blockchain settles in seconds, T+0.
Smart contracts auto-distribute dividends the moment rent is received. No transfer agent, no custodian, no reconciliation.
Traditional path, 11 steps, 3 weeks, $2,400 in fees. Tokenized path, 3 steps, instant, $12 in fees. Same outcome.
The efficiency argument is real. I won't dispute it. But institutional adoption of infrastructure doesn't validate every product built on it.
The railroad transformed America. Most railroad investors still lost money. Both were true simultaneously. The numbers. BCG projects $16 trillion in tokenized assets by 2030. That is not speculation. That is infrastructure planning. The BIS, the IMF, the Federal Reserve, all published serious research on tokenized settlement systems. The EU's MiCA regulation went into full effect December 2024. The most comprehensive digital asset framework anywhere on Earth. Singapore MAS, UAE DIFC, UKF CA Sandbox, Hong Kong SFC, all moving. The question for investors is no longer, is this real? The question is, how do I participate intelligently? These are not experiments. They are live operating infrastructure, processing real transactions at institutional scale. The Deutsche Bank, HSBC, and Citi have all launched tokenized bond or deposit programs by 2025. The World Economic Forum estimates tokenization could unlock $4 trillion in additional liquidity by streamlining global settlement. Goldman Sachs has built tokenized bond infrastructure. HSBC launched tokenized gold. These are balance sheet commitments. The shift from is blockchain real to how do we build on it happened quietly between 2022 and 2024. When central banks, regulators, and the world's largest asset managers all move simultaneously, something is happening. This is the mainstream remaking itself. Not at the edges, at the center. And the first use case that brought this to retail investors is one you already understand. The asset class that locked most people out to begin with, being cracked open. Act 4. Real-world use cases you can access today. Starting with the biggest, real estate. Real estate is the world's largest asset class, over $300 trillion globally. Historically high yield, viciously inaccessible to small investors. A $200,000 rental property tokenized into 2,000 tokens at $100 each. You buy 5, you own 0.25% of the property. You receive 0.25% of monthly rental income automatically via smart contract.
I put $200 into a rental property. First month, I got $1.74 in rental income. That sounds small, but I own a fraction of a real building.
The honest counter-argument: you are often not on the deed directly. You hold a contractual claim through a special purpose vehicle. If the platform goes bankrupt, the SPV may enter proceedings. Platforms operating today: Realty, Arrived, Fundrise. Minimums range from $10 to $100. Most require U.S. residency or accredited status. The feeling of owning a fraction of a real building is genuinely different from watching a stock ticker. Most platforms use a Regulation A+ or a Regulation D offering structure. This determines who can invest and how. The realistic expectation: 4 to 8% annual yield from rental income plus potential appreciation. Not guaranteed. Realty properties are on the Ethereum blockchain. Arrived Homes uses SEC qualified offerings. Fundrise offers a REIT-like structure.
The thing that changed for me was I stopped thinking I can't afford real estate and started thinking I can own a fraction of real estate now.
That mindset shift from all or nothing to fractional participation is the core of what tokenization enables. Before we move to art, the honest summary: tokenized real estate is real, regulated, and operational. Read the documents first. Second category, fine art. Historically returns 7 to 9% annually, non-correlated with equities. Until now. Minimum meaningful participation required millions. Masterworks purchases museum-quality art, files with the SEC, and sells fractional shares. Entry from $500. When the work eventually sells, typically 5 to 10 years, shareholders receive proportional proceeds.
Art valuations are subjective. This is not a bond with a yield. You are betting on taste as much as capital.
Correct. Art is illiquid, long hold, and subject to taste risk, which is why it should be a small allocation, 5% or less, not a primary one. Collectibles, rare sneakers, vintage watches, trading cards. Platforms like Rally and Otis offer fractional ownership from $25.
The non-correlation is what institutions have valued for decades. Blue chip art has moved independently of equities in 11 of the last 15 crises.
Masterworks has returned an average of 15% net to investors on completed exits as of 2025, across 30-plus completed sales. But the average hold period is 5 to 10 years. This is patient capital, not a trading position. Summary: art is a real alternative asset with a real track record. It is illiquid, taste-dependent, and long hold. Position accordingly. Third and most interesting emerging category: physical infrastructure. Wind farms, solar, farmland, data centers, characterized by stable inflation-linked cash flows and the highest historical barriers to entry of any asset class. A tokenized wind farm in Texas raises $50 million at $500 per token. Token holders receive quarterly distributions from electricity revenue. Farmland. The NCREIF Farmland Index has returned 11% annually over 20 years. Institutional pension funds have held it for decades. Now accessible at $100 per token via platforms like AcreTrader and farmed together. The asset is real. The cash flow is real. The ownership record just lives on a blockchain instead of a paper certificate. Why infrastructure specifically? Because it has legal monopoly characteristics. A wind farm that won a government contract will produce revenue for 20 years. Infrastructure tokens often pay quarterly rather than monthly. Distributions tied to actual energy production data, not platform estimates. Risk. Infrastructure projects have long capital lockup periods, 10 to 20 years. Liquidity on secondary markets is minimal. Summary. Infrastructure tokenization is the most institutionally credible category and the least liquid. Know your time horizon. 3 categories, dozens of platforms, billions already deployed. But here is what most videos will not tell you. What happens when things go wrong? And things can go wrong in ways traditional regulation hasn't fully addressed.
All right, let's talk about the real risks. I've been waiting for this part.
Risk 1, platform risk. You are not going directly on the property deed in most structures. You hold a token issued by an SPV. If the platform company goes bankrupt, that SPV may be drawn into proceedings. Several early tokenized platforms have shut down with investor funds in legal limbo. This is documented, not hypothetical. Risk 2, regulatory uncertainty. The SEC has not issued comprehensive guidance covering all tokenized asset structures. Some tokens may be deemed unregistered securities retroactively, triggering enforcement that freezes your position. Risk 3, liquidity risk. Secondary markets for most tokenized assets remain extremely thin. You can buy in 3 minutes. Selling at a fair price could take weeks or months. Do not treat this as liquid. Risk 4, smart contract risk. The code that automates your distributions is not infallible. Smart contract exploits have cost the DeFi industry over $10 billion since 2018. Audit quality varies enormously.
Risk 5, valuation opacity. Who decides what your illiquid token is worth right now? The platform. That is a conflict of interest.
The better platforms commission independent quarterly appraisals. That is your first filter when evaluating any platform.
Before investing $1, check regulatory registration, audit history, SPV legal structure, exit mechanism, fee schedule.
My rule: if the platform cannot explain your exit mechanism in one paragraph, do not invest.
I learned to read the offering documents first, the hard way.
The videos that only tell you about upside are selling you something. We are not. We are preparing you.
The documents that most retail investors never read, the offering memorandum, the SPV operating agreement, contain your actual rights.
Mitigant: look for platforms where the SPV is bankruptcy remote from the operating company. They do exist. They are worth the extra time.
The Howey test. A token may be a security if there is investment of money, a common enterprise, expectation of profits from the efforts of others. Most tokenized real estate platforms already operate as securities offerings. The cleaner ones are SEC registered. That is your baseline filter.
I once tried to sell a position I needed to exit. The secondary market had exactly one buyer, offering 30% below my purchase price.
Secondary market liquidity is the most underappreciated risk in this space. Calculate your maximum hold period before entering.
Better platforms publish third-party security audit reports. Firms like Certic, Hacken, or OpenZeppelin. Absence of a published audit is a red flag.
Platforms that use independent quarterly appraisals from licensed real estate appraisers. Those are the ones that earn trust. They exist.
7-point checklist. 1. Regulatory status. 2. Audit reports. 3. SPV legal structure. 4. Bankruptcy remoteness. 5. Exit mechanism. 6. Fee structure. Platform fees above 2% annually meaningfully erode returns on a 6 to 7% yield asset. 7. Independent valuation. Position sizing rule. No single tokenized platform position should exceed 5% of your investable assets at this stage of the market.
I've changed my position across this conversation. I'm not against tokenized assets. I'm against uninformed participation. The difference matters.
And the good news? The risks we've described are knowable, manageable, and increasingly being addressed by the better platforms.
The investors who survive and compound in new asset classes are not the most optimistic. They are the most prepared. Act 6, the regulatory map. Because where you invest and from where matters enormously. United States, SEC registered pathways exist. Reg A+, Reg CF, Reg D. Legal. Not simple, but navigable. European Union. MiCA went into full effect December 2024. One registration, 27 markets, the most complete framework anywhere. Singapore, NAS, Project Guardian, live institutional pilots advancing. UAE DIFC and ADGM, actively competing to become the global issuance hub. UK FCA Sandbox, advancing. Hong Kong SFC, licensed virtual asset platforms operational. Regulatory clarity is expanding globally. The investor rule. Only use SEC registered, MiCA compliant, or MAS licensed platforms. Not a guarantee of success, but the strongest available signal. How to actually start. Step 1. Education before you open an account. Step 2. Regulatory check on every platform. Step 3. Read the legal structure. At minimum, the offering memorandum. Step 4. Position size only what you can lock up for 3 to 7 years.
Step 5. Start small. Learn the platform. Understand your actual returns before scaling.
Skepticism is a tool, not a conclusion. Use it to research, not to dismiss.
The infrastructure is real. The institutional adoption is real. The risks are real. The opportunity for informed investors is real. In the U.S., the Jobs Act pathways allow non-accredited investors to participate. Reg CF, up to $5 million raises. Reg A+, up to $75 million. MiCA creates legal clarity on token classification, issuance requirements, and investor protections across all 27 EU member states simultaneously. Singapore, MAS, Project Guardian has moved from pilot phase to institutional deployment. Standard Chartered, DBS, and JP Morgan, all active participants.
Regulatory compliance is not a box to tick. It is your primary defense against the catastrophic tail risks we described in Act 5.
Regulation is not the ceiling of this market. It is the foundation. The more robust the foundation, the higher the ceiling.
Practical start point. Open one SEC registered or MiCA compliant platform. Invest the minimum. Run the full experience before scaling. Monitor one full distribution cycle, typically monthly or quarterly. Understand how income is reported and taxed before adding capital. After one full year of data, you have real information. Actual yield, platform reliability, liquidity reality. Then decide on scaling. The question is not whether tokenized assets will exist in 2030. They already exist. The question is whether you participate intelligently. 3 things to take with you. 1. This space is an early infrastructure phase, not speculation phase. 2. The risk is in the products built on the infrastructure, not in the infrastructure itself. Know the difference. 3. Informed investors who understand the structure and the risks are positioned to benefit as this matures.
I'm not rich. I'm not an expert. I just finally got through the door.
The technology works. The question is always whether the specific product you choose is built responsibly on top of it.
Do your homework. Then make a decision. That's what investing has always required.
If this helped you think more clearly about tokenized assets, subscribe, share, and drop your questions below.